네, 미국 시카고 서부거래소와 또 월가의 현지 동향을 생생하게 전해드리는 버니의 미국 주식 시간입니다. 코로나 이후 글로벌 증시는 계속해서 최고점과 또 최저점을 왔다 갔다 하는 등 변동성이 유난히 심한 모습을 보여주고 있는데요. 앞으로 또 어떤 변수가 터질지 모르는 상황 속에서 이 변동성이 단발성인지 아니면 또 나타날 수 있을지 전망과 또 전략들을 들어보도록 하겠습니다. 지금 바로 만나보시죠.
Well, if we think about it, currently we're in a corrective phase, and we identified problems in the second half of last year several times where we saw the internals, the advanced decline line, the number of new highs versus new lows failing even as the market was making new highs. So now what we have is we've entered into this price decline. So if we ask the question, given the fact that the S&P declines anywhere between 10 and 20%, so not more than 20 and at least 10%, how many times has that occurred since 1946? And what's the average recovery that gets back to the highs? So if we look at it, we could say 17 times 6 months, 29 times 4 months. That looks good. I don't know if that's possible or not. 34 times 11 months, much longer. 40 times 18 months. Now, what we know is that because there's this internal long-term inherent bias to higher prices in the stock market, you just don't get that easily. You have to endure something. And what you're enduring is this volatility, these price declines. So let's go to the next slide and see what the answer is. 29 times 4 months. So the market goes down more than 10%, S&P 500, more than 10%, and it has not done that yet, but not more than 20%. So in other words, it's not a catastrophic affair. 29 times the average recovery, not all of them, but the average recovery is 4 months. So what happens is the stock market, which is a forward-looking vehicle, is thinking ahead and trying to identify what the next things that are important to it are. So as much as it hurts to live through these corrections, they're fairly common. We've had 76 years and 29 declines. That's more than 1 out of 3. So if every third year you anticipate a decline of this magnitude, 1 out of every 2.5 years, that's the price we pay, short-term volatility, to get these long-term returns. And the thing that's so impressive about this is that the peak to trough on all these 29 times has averaged only 4 months. Now, some of them have gone substantially longer. The 1987 was a multi-year issue, but that one declined more than 20%. So we weren't really thinking about that. The 1999 to 2002 was another substantial correction. Those don't count. So we're just looking in this 10 to 20% window. And what we can see, like 2018, the end of 2018, that was a 10% decline, and we came out of that fairly quickly. So I constantly come back to the fact that given the fact that we're in a corrective phase, given the fact that the Fed is raising interest rates, what does that mean for the stock market? And there's two things that happen. If we go into a recession, the stock market will anticipate that ahead of the fact that the actual data comes in, and those will be more significant setbacks. If we just go into what's called a growth slowdown, okay, where we don't go into recession, but we go from, say, 4% economic growth to 1.5 to 2, and then back up to 4 again, those are really great buy opportunities. So this chart right here identifies the two different components and what it looks like in the stock market. So the pink circles are true recessions, and this goes back to 1946 also. The pink circles are true recessions. So these declines right here and right here are much more significant than the growth slowdowns, the blue circles. The growth slowdowns don't slow down quite as much. So what we want to have happen, if we can help it, is we want to be in a growth slowdown and not a recession. That's why we look at wage growth, consumer spending, and we think about this. If we raise interest rates from basically the Fed funds rates at 0 and we take the Fed's funds rate up to 1.5%, is that really going to turn our world upside down and cause us to go into recession? Well, I've been around when that funds rate was at 20% in 1983, 1982. We were way high. Well, I shouldn't say the funds rate. The 2-year notes were yielding 20%. The funds rate was at 15, 16%. We were at 15, 16%, and then we went down to 9%. We went back up to 12 or 13. All through most of the 80s and early 90s, we got to 7%. And then we really started to take this down, say sub 2000, sub 95 to into 2000, and then beyond that. In 2003, the funds rate finally went below 3%. And it has stayed below 3% and gone lower, lower, lower over time. Well, we've had a couple of things go on. We've had the 2008 crisis. We've had the COVID issue. We've had things that have kept the funds rate down. But we can survive very easily, I believe, at a 1.5% funds rate without causing too much of an issue. Let's look at the next slide. The biggest driver of stock market returns long-term is demographics. So what you want are the right amount of people, the biggest amount of people in this biggest window where they make money and they spend it. So if we think about who that is, that's the 30 to 39-year-old wage group. And the people that are forecasting that, okay, are going to be the people that are in the 20 to 29-year-old that go into the 30 to 39-year-olds. People that are 20 to 29-year-olds make money, they earn money, they spend everything they have. People that are 30 to 39 years old make money, may make much more money than the 20 to 29-year-olds, and they spend a great portion of their money. They're first-time buyers of houses, they buy better cars, they do all the things that we need to do to drive the stock market returns, or drive the economy, which in turn is indicated by stock market returns. We could go back and look at this, and it is amazing over 150 years what it's looked like. So if we go back to, say, 1880s and that sort of thing, this whole thing drives us. Well, what do we have right now? From the 2008 bottom, okay, through almost 2030, that group of 30 to 39-year-old people are continuing to increase in terms of population. That growth rate is great. This is about where we are right now, say right here, you know, like a little bit into that 2022 area. So we've still got a great period where not only does the 20 to 29-year-old group stay relatively flat, but the 30 to 39-year-old group continues to grow. So I think every buying opportunity that we can see between 2009 and 2029, 2030 will most likely be great buying opportunities. We just have to be there when they occur. And this one looks like it's shaping up to be a good buying opportunity. In other words, we get prices that are attractive to purchase, that they've come off their highs.
네, 지금까지 버니의 미국 주식 만나보셨습니다. 계속해서 도움 받아보고 싶다 하시는 분들은요, 샵 0082번으로 버니의 미국 주식 이렇게 보내주시거나 하단에 QR코드 찍고 보내주시면 되겠습니다. 저희가 함께 하실 수 있게 안내 도와드리도록 하겠습니다. 자, 이어서는요, 다음 고수익 작전으로 가보시죠.